Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sinotrans Limited annual report. Sinotrans Limited provides a wide range of integrated logistics services to cater to various business needs. At the core of their operations are three primary segments: agency and related business, professional logistics, and e-commerce. The company offers a diverse array of services under these segments. In terms of sea freight, air freight, rail freight, shipping agency, terminals and containers, yards, feeder/barges, logistics information systems, and supply chain security, Sinotrans Limited provides comprehensive solutions for businesses looking to transport goods across different modes of transportation. In addition to these services, the company also engages in e-commerce business, including cross-border e-commerce logistics e-commerce platform, and logistics equipment sharing platform. This highlights their commitment to adapting to changing market trends and providing innovative solutions to meet emerging needs. Furthermore, Sinotrans Limited offers integrated logistics solutions that cater to specific industry requirements, such as contract, project, chemical, cold chain, and other logistics services. They also provide a range of value-added services, including freight forwarding, logistics and storage, courier, transportation, lifting, container leasing, storage yards, container loading and unloading stations, and terminal services. The company's commitment to innovation is evident in its provision of tracking and monitoring services for logistics equipment, allowing businesses to stay informed about the movement of their goods. With a strong online presence, Sinotrans Limited makes it easy for customers to access its services from anywhere in the world. Sinotrans Limited market capitalization of $44 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Sinotrans Limited holds a significant advantage in their industry. Sinotrans Limited trades at a lower price-to-earnings ratio of 8 times and a lower price-to-book ratio of 0.76 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company is worthy of investment, or could it be an extended period of low valuation or a value trap. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 6.41%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be identified through various sources, including government grants, financial subsidies, and industry-specific trends. In this case, government grants receivable increased by Rm 185 million, indicating a significant driver of revenue growth. Financial subsidies for the logistics industry also contributed to revenue growth, increasing by Rm 63 million. Industry-specific drivers, such as the increase in procurement limits for transportation and logistics services from related parties, also played a crucial role in revenue growth. Additionally, agency and related business, including advance payment mode contracts with customers, logistics and transportation service contracts, and estimated output tax on transaction price received or receivable, contributed to revenue growth. Company-specific drivers, such as Sinotrans Logistics Co., Limited, significant share of total other receivables, also impacted revenue growth. Furthermore, equity investment in China Southern Airlines Logistics Co., Limited, had a fair value of Rm 939 million, indicating potential for future revenue growth. However, there are also challenges and uncertainties that may impact revenue growth. Difficult to improve profitability indicators affected revenue growth, while uncertainty regarding revenue growth impacted the company's results of operations. Weak European macroeconomic conditions, including sluggish industrial and consumer demand, sustained decline in European road freight rates, rising labor costs, and inelastic rise in operating expenses also posed a challenge to revenue growth. In conclusion, government grants, financial subsidies, industry-specific trends, company-specific drivers, and tax concessions were the primary drivers of revenue growth. However, challenges such as difficult to improve profitability indicators, uncertainty regarding revenue growth, and weak European macroeconomic conditions may impact future revenue growth. The net income of a company has experienced fluctuations over the years, with both increases and decreases observed. In some instances, net income rose significantly, such as a 69.7% increase in 1 year. However, there were also periods where net income declined, including a 23% drop from FY 2024 to FY 2025. Profit margins have also undergone changes, with both increases and decreases recorded. While profit margins improved in some cases, they decreased in others. For example, operating profit margin dropped from 50.6% to 43.1%, while net profit margin fell from 50.5% to 43%. The reasons behind these changes are varied and complex. Increased trade protectionism and policy uncertainty have had a negative impact on the company's performance. The frequent and erratic tariff policies of the U.S. have also contributed to the fluctuations in net income and profit margins. Additionally, weak European macroeconomic conditions, sluggish industrial and consumer demand, and rising labor costs due to driver shortages have all played a role. Furthermore, an increase in operating expenses such as energy costs has also affected the company's profitability. The decline in European road freight rates has also had a negative impact on the company's performance. Overall, these factors have contributed to the changes in net income and profit margins over the years. The company's financial performance indicates a consistent generation of positive operating cash flow. The data presented across various pages shows a net inflow of cash from operating activities for all years, with some instances even exceeding RMB 3 billion. This is further supported by the fact that total current assets consistently exceed total current liabilities, indicating a strong ability to meet short-term obligations. The company's performance in both quarters, as well as its overall annual results, demonstrate a positive trend in operating cash flow. The presence of net inflows in certain accounts and the alignment between operating income and net cash flows from operating activities also suggest a healthy financial position. Overall, these indicators confirm that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over time. The total debt has increased by RMB 1,959,584,585.67, with short-term borrowings rising by RMB 958,521,409.18 and long-term borrowings increasing by RMB 487,148,999.3. This substantial increase in debt level is a notable trend. However, the interest expenses have shown mixed results. In some cases, they have decreased significantly, such as from RMB 406,198,794.37 to RMB 342,322,250.33, a decrease of 15.6%, and from RMB 308,219,263.11 to RMB 43,441,489.01, a decrease of 86.1%. On the other hand, interest expenses have also increased in some instances, including by RMB 117,378,728.78 and by 68.5% from RMB 2,680,564.91 to RMB 4,489,174.44. Overall, while the company's debt level has increased substantially, the impact on interest expenses is more nuanced, with both decreases and increases observed. The recent performance of various business segments has been a mixed bag, with some areas showing significant decline, while others have managed to stay afloat or even experience growth. In terms of poor performance, the logistics segment excluding project logistics saw a substantial decrease of 22.73%, page 26. Additionally, the forwarding and related business segment suffered losses, with external revenue decreasing by 15.13% and segment profit plummeting by 17.41%. The e-commerce business also experienced a drastic decline in segment profit, dropping by an alarming 87.65%. On the other hand, some segments have shown neutral performance or even growth. Within the logistics segment, Project Logistics saw an increase of 5.08% in external revenue. Furthermore, certain subsegments within forwarding and related business, specifically freight forwarding and shipping agency, managed to stay profitable year-on-year. Overall, these results indicate that while some areas are struggling, others have been able to maintain stability or even experience growth, highlighting the need for targeted strategies to address underperforming segments. Management's vision for the company is centered around becoming a world-class, innovative, integrated logistics enterprise. To achieve this, they have identified 4 key areas of focus: strengthening the foundation, driving business development through strategic guidance, tackling key problems through reform, and empowering cultural cohesion. The company plans to establish a new carrier model with a clear strategic pathway, characterized by strong product mix capability, full process delivery capability, and robust ecological aggregation capability. This will be achieved through investments in new assets and expanding operations through acquisitions. Management also aims to revitalize existing infrastructure assets through investments, forming a virtuous cycle of investment, broadening financing channels, and enhancing sustainable operation capability. Additionally, they plan to advance corporate culture development by 2025, promoting cultural revitalization and dissemination, strengthening cultural empowerment, and consolidating cultural support to build a brand system. The company will also conduct studies on its development strategy, establish a basic strategic framework, formulate medium and long-term development plans, guide and examine the strategic development plans of major subsidiaries, research new markets and businesses, and analyze sustainable development (ESG) strategic plans. Furthermore, management is increasing its shareholding in Antong Holdings through a proposed investment of no less than RMB 300 million and no more than RMB 600 million. Overall, management strategy is focused on driving growth through innovation, investments, and cultural empowerment, while also prioritizing sustainable development and corporate culture development. The company has made significant moves through acquisitions and divestitures. In terms of acquisitions, the company has taken an equity stake in 7 companies, expanding its portfolio and influence in various sectors. Additionally, it has formed and acquired shares in listed companies by converting investee entities into publicly traded firms. On the other hand, the company has also engaged in strategic divestitures to optimize its operations and focus on core areas. Specifically, it has transferred 100% equity interests in 6 subsidiaries to BOC Sinotrans, Warehousing and Logistics Closed-End Infrastructure Securities Investment Fund. This move is expected to streamline the company's business and improve efficiency. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out cash to its investors, with a notable example being the RM billion, 41,040,240.89 interim dividend paid in 2025. Furthermore, the proposed final dividend for 2025 is set at RMB 0.155 per share, which translates to a total amount of RM billion, 111,931,440.19. In addition to dividend payments, the company has also engaged in share buybacks. In 2025, approximately RMB 0.48 billion was used for share repurchase, resulting in the acquisition of 81,182,948 A shares and 18,964,000 H shares. This demonstrates the company's commitment to returning value to its shareholders through various means. That concludes the financial summary for Sinotrans Limited. Feel free to comment below, and I will be happy to answer them when possible.